A very good afternoon, all of you. Hope you all are doing good. May God bless you all. Welcome to Commerce second year classes. Till yesterday, we did accountancy part of Commerce paper 2, isn't it? So part 1, part 2. Part 1 is theory, 50 marks. Part 2 is accountancy, 50 marks. So in the last 2 weeks, we have completed the second segment. It is 50 marks we have covered. All the numericals starting from, say, partnership, consignment, NPO, and depreciation. Now, the remaining 50 marks, which comprises of theory, that is part part 1, okay, having 3 sections, covers 50 marks. Let us see the blueprint once. Say section A. Section A, you'll get 3 LAQs. You have to answer any 2. 2 times are 20 marks. 2 times are 20. Then section B, you'll get 6 SAQs, short answer questions. You're supposed to answer any 4. 4 fives are another 20. Okay, and the last section, that is section C, will have 8 questions, which are VSAQs. You have to answer any 5. 5 twos are 10. This is how your total 50 marks are covered. Okay, section A, section B, section C. So today, tomorrow, day after, and on Sunday, we are going to cover all these important questions what I have prepared. We are going to have a look at all these question and answers. Okay, so moving forward, we'll take our question number 1 for today. That is, what is financial market? What are financial markets? And explain the difference between money market and capital market. Okay. Now, to begin with, what does financial market mean? That let us see. What does financial market means? See, if we want to buy vegetables, we go to a vegetable market. If we want to buy fruits, we'll go to fruits market. If we want to buy grains, we go to a grains market. Similarly, if people want to buy financial instruments or they want to buy securities, okay, if they want to buy financial instruments or financial securities, they will approach a financial market. So financial market is a place or it is a platform where people can buy and sell financial securities. Okay, financial market is a place where, like in vegetable market, the one who wants to buy and the one who wants to sell vegetables, both will meet. In the same manner, in a financial market, person who wants to buy financial securities and the person who wants to sell financial securities, they both will meet. Let us take one example. Suppose there is a person. Let us say this is Mr. A. He is having surplus money. He is looking for investing it somewhere. Instead of depositing in the bank or keeping the money at his home, he is thinking of investing somewhere. And let us say there is one company. Okay, let us say there is one company and this company wants finance for its expansion. Okay, so how does this company do that? Company can issue shares or debentures, isn't it? You have learnt in your first year sources of business finance. Whenever any business requires finance, it will go to public by issuing shares or debentures or bonds. So now let us say this is a company by name X Limited. So see here, A, I said, is having surplus money and X Limited is the company which is in need of money. These two people will meet in a place called as financial market. And A will buy shares of X Limited and X will issue shares of its own to A. This is how the exchange takes place. This is how the exchange takes place between the person who are having surplus money and the person who are in need of money. Right? Now, the requirement of any company or a firm, for the financial requirement of any company or a firm, basing on the duration, can be of two types. Can be of two types. One is either the funds are needed for short term. Either the funds are needed for short term or the funds are needed for long term, right? For short term or let us say long term. The market that caters to the requirement of short-term finance is different, and the market that serves the long-term finance requirement is different. The market which serves the purpose of short-term, we call it as a money market. What do we call it? We call it a money market, right? So money market is a market which caters, which serves the need of short-term short-term finance requirement. And if the funds or if the finance is required for a long term, the market that serves the purpose is a capital market. So we can say that money market and capital market, these two are the components of financial market. Right? Money market and financial market, these two are the components of a financial market. One is catering to the need of short-term finance and the other one is catering to the need of long-term finance. 90% times this question has been asked in your IP final exam, right? The question is like, what are financial markets and what are the differences between capital market and money market? So let us learn what is the difference between a money market and capital market. One point you too can add by what you have listened for the last 5 minutes, you can add one difference. I told you money market caters to the need of short-term finance and capital market serves the purpose of long-term finance. This is one difference. अगर कम वक्त के लिए पैसा चाहिए तो आप मनी मार्केट में जाइए, अगर आपको ज्यादा अरसे के लिए पैसा चाहिए लंबे वक्त के लिए तो आप जाइए कैपिटल मार्केट, है ना? ओके, so let us learn in detail and trust me, if you pay attention till just for 10 minutes when I am discussing the differences here itself, in the class itself, you'll understand and you'll be able to frame the answer. You'll be able to draft the answer on your own. Okay, so now let us move further and okay. We are discussing the differences between money market and capital market. We are discussing the difference between money market and capital market. What is money market? What is given? It deals with short-term credit instruments not exceeding 1 year. If the capital requirement or the finance requirement, if the financial requirement is for less than 1 year, if you want finance, if you want funds for 6 months, 8 months, 9 months, 10 months, 11 months, where will you approach? You will approach a money market. So money market deals with short-term credit instruments not exceeding maturity of less than 1 year, not exceeding maturity of 1 year. Whereas capital market deals with long-term finance. If your financial requirement is for more than 1 year, then you will go to a capital market. But if your financial requirement is for less than 1 year, you'll go to a money market. Very simple. Second one, who are the major players in money market? That is, what are the institutions or what are the agencies that deal in money market? That is what the deal in money market instruments or short-term instruments that we are learning. What this point is, what are the agencies or what are the institutions that will help you raise finance for short term? That is, they are the ones who are helping money market, we can say. The major players are either commercial banks or RBI, that is Reserve Bank of India, LIC, Life Insurance of India, GIC, General Insurance Corporation, UTI, Unit Trust of India. These are the agencies or the institutions that are the major players who help raise short-term finance. That is money market players. They are the ones who play in, let us say, money market. And the major players in case of capital market are financial institutions, money, foreign investors, and individual investors. Again, here also, like if let us say, for example, Reliance Industry is there. Reliance Industry is there. It needs finance. Okay, it will issue shares to public and can raise finance, or it can issue debentures to public and can raise finance. So, who are the players in case of capital market? It is the big financial institutions, foreign investors, and individual investors. Right? Then the third one, it deals with credit instrument like treasury bill, commercial paper, certificate of deposit, bills of exchange. These are the instruments of money market. Now again, now tell me, treasury bill, commercial paper, are they short-term credit instrument? The answer is yes. The answer is yes. Treasury bill, certificate of deposit, commercial bills, commercial papers, these are short-term credit instruments. Okay, these are short-term credit instruments because treasury bill is issued either for 90 days or 180 days or 270 days or 364 days. I repeat, treasury bills are issued for a period of 90 days, 180 days, 270 days, or 364 days, less than 1 year. So these are the instruments of money market. Whereas capital market instruments are shares, debentures, bonds. And these are issued for, say, 3 years, 5 years, 7 years, 9 years, like this. Debentures, 3 to 5 years. Bonds, 3 to 5 years. Shares, of course, for a very longer period of time, right? So, what are the instruments of money market? Treasury bill, commercial paper, commercial bill, certificate of deposit. Even if you write these two, enough. And what are the instruments of capital market? Shares, debentures, bonds. Enough. Next is, a money market is engaged in the supply of working capital requirement for short term. Okay. Now, capital of any company can be divided into two. It is fixed capital and working capital. What is it? Fixed capital and working capital. What is working capital? Working capital is simply means the fund required for day-to-day operations. It is the money that a company requires to meet day-to-day operations, that is called as working capital. We have a formula for working capital. It is current assets minus current liabilities. And you understand this? Working capital means fund requirement to meet day-to-day operations. We call it as working capital. Like say, to pay salaries, we need money. To pay rent, we need money. To purchase raw material, we need money, right? All these requirements, okay, the money required for all these requirements, we call it as working capital. So money market is for short period, right? So it caters to the requirement of working capital because it is for day-to-day operations. It is for a shorter period. So we say that money market is engaged in supply of working capital, whereas capital market is engaged in supply of fixed capital. See, I told you working capital means it is the fund required to meet day-to-day operation. And then what is fixed capital? Fixed capital means it is the finance, it is the amount required for acquisition of assets. For acquisition of assets. Suppose a company wants to buy a machinery, 50 lakhs, right? The amount spent on buying a machinery is called as a fixed capital because that amount is spent and is dead and is blocked for a long period of time. If you purchase a machinery for 50 lakhs, that amount is blocked, no? Will we get the returns immediately? Obviously, no. So that is called as a fixed capital. So money market supplies fixed capital. In short, we can say, capital market supplies fixed capital and money market supplies working capital. Very simple. Again, working capital means fund required for day-to-day requirement and fixed capital means amount spent for purchase of a fixed asset, whether it is machinery, furniture, land and building, like that. Next, hope you all are following. As I said, please pay attention. 10 minutes, you can bag 10 marks. You can easily pocket 10 marks. Next, fifth one, its instruments enjoy high liquidity. Its instrument, what are the instruments? Treasury bill, commercial paper. They enjoy high liquidity. Now, what does liquidity means? Very simple. Converting something into cash is said to be liquidity. Okay, converting something into cash. Suppose I have this stylus, or say let us pen. I sold this pen for 20 rupees or 50 rupees, right? So what did I do? I liquidated this marker or stylus. I liquidated this stylus, we say. So liquidity means easily convertible into cash. Sorry, money market instruments, treasury bill or commercial papers are easily liquidated. They can be easily converted into cash. So we say that they have high liquidity. Whereas capital market instruments have low liquidity. You cannot easily convert them into cash. You have to wait for the right time. Suppose you purchase shares of a company. You know, share market is very speculative. We are going to learn that also in the next question. Share market is very speculative. The value of share goes up and down depending on the demand and supply. So if I want to immediately convert shares into cash, let us say I purchase a share of Reliance Industries for 100 rupees and I want to sell it, but due to some reason, the value of share came down. Will it be wise for me to sell it? Answer is no. I have to wait when the price goes up, no? So it takes little time. So we say that the instruments of money market have high liquidity, whereas the instrument of capital market have low liquidity. That is, they cannot be very easily sold into and converted into cash. They can be. It is not that risk always is there, but still you can convert them, but not as easily as a money market instrument. Okay, chalo, good. Next is, its instruments are much safer and the risk level is low. See, remember, whenever investment is for short period, whenever the liquidity is high, it means it has low risk and low returns. More the risk, more the returns. Less the risk, less the return. So here risk is less as well as returns also will be less. Okay. So its instruments are much safer and the risk level is low. So less risk is less because you are investing for a short-term period, risk is less. And here its instruments are not safe with regard to returns and repayment of principal amount. Right? Here risk is high. In case of capital market, risk is high and there is no guarantee. Like if you purchase equity shares, there is no guarantee of redemption of that amount. If you are investing in debentures, your amount will be repaid. Redemption is there. But if you are purchasing or investing in equity share, there is no redemption. So that is what this point says. There is no guarantee of repayment of the principal amount in case of capital market. Then investors cannot expect high return. I told you just now. Less risk, less return. More risk, more return. If the risk is less, obviously returns cannot be high. Or you can say, I can rewrite this point as investors cannot expect high return. Or we can also say that the returns are low. Where there is low risk, the returns are low. Where there is high risk, returns are high. So in case of money market, risk is low, returns are low. In case of capital market, risk is high. Risk is high. Obviously, returns also will be high. If you wait for a substantial period, for a considerable period of time, returns will be very good in case of capital market. Next is, instruments are of high value. Like if you take, for example, treasury bill, the face value of one treasury bill, 1 unit will be 25,000. It will be in the denomination of 25, 50, 75, 1 lakh like this. So if you want to purchase one treasury bill, its value is how much? 25,000. So in case of money market, the value of instruments is very high. Whereas in case of capital market, The face value of debentures or shares, face value of shares normally will be 10 and debentures it would be 100, right? So the face value of the instruments in case of capital market is low as compared to the face value in case of money market. Money market is, there is a wide gap. As I said, each treasury bill will be of 25,000, one unit, 25,000. So you can see, whereas here it is only 10 rupees. Okay, so the face value is low. Then, in case of money market, you do not need a place for transaction. Money market does not need a place for transaction for exchange of securities. It can be done over phone or internet. Through internet, it can be done. Whereas capital market needs a place. Okay. We need to have a market where we can do the trading of the instruments of capital market. Then, who is the regulatory body for a money market? Reserve Bank of India. Reserve Bank of India is the agency that regulates our money market, and SEBI regulates the capital market. SEBI stands for Security Exchange Board of India. SEBI means what? Securities Exchange Board of India. Okay. RBI stands for Reserve Bank of India. So RBI is the regulatory body of money market and SEBI is the regulatory body of capital market. Just these 10 points and a little introduction, you'll bag 10 marks. Hope you all understood it. So easy, isn't it? Okay. Shall we move to the next question? Yeah. We are going to the next question. Okay, so I'm taking next question. Hope you all understood this question. Please just go through once again after the class. Then the second question is, what is stock exchange and what are its functions? What is stock exchange? What are its functions? Stock exchange is a place, or I should say, just now we learned financial instruments, no? Financial instruments are traded in stock exchange, I can say. Okay, financial instruments are traded in a place called stock exchange. Okay, stock exchange exercises certain functions based on the aims of its inception and development thereof. I told you, stock exchange is a place where securities are traded, right? It is a market. We also call it a stock market, right? Then, now let us see what are the functions. Now, while learning financial market, we learn one point, no? Capital market needs a place for trading. Capital market needs a place for trading, or we need some infrastructure to do trading of the instruments of capital market. For money market, we don't need any such thing. Money market instruments can be purchased or sold over phone or internet. But money market, capital market instruments, shares, debentures, bonds, they need a place for trading. That place is called as stock exchange. Okay, that place is called as stock exchange. So the first function of stock exchange is it provides infrastructure for trading. It provides a platform. It provides the place and all the required infrastructure for buying and selling of securities. Securities are what? shares, debenture, bonds. Where do we purchase them and sell them? We do that at a place called stock exchange. So stock exchange is providing a place, a platform where one can sell securities and the other can buy securities. Very simple, right? As it is given in the slide here, you'll get 10 marks, complete 10. Second one is it provides information regarding prices. Now see, stock market is a continuous market. From Monday to Friday, continuous trading will be done. And it is a very speculative market if you know about that. Every moment, every minute, the prices of shares or debentures or securities, let us say in general, keeps on changing. Prices continuously कम ज़्यादा होते रहते. तो जो भी investor है या जो भी buyer है, they need to have a knowledge about the change in prices so that at their favorable price they can either purchase or sell. So this information of change in prices is provided by stock exchange, right? Whatever prices prevailing in the market, let us say Monday 10 o'clock, 10 a.m. What is the price of security? Let us, I am having shares of some, say, Tata company. The price of that Tata Steels is, let us say, 112 rupees, right? But I am waiting. I want to sell my shares if I get a price of, let us say, 120. So by 10:30, the prices went up to 120. So I can sell this off. So when can I do this? When can I take this decision? If I am kept updated about the change in prices, isn't it? So that part is again done by stock exchange. Provides information regarding the prices. It gives sensible information through reliable sources and publishers. It is not any fake news, but 100% genuine information will be given by stock exchange so that the proposed investors knows the quotation and the investor knows the price of his holding. Okay, that's it. So stock exchange provides the information regarding the prices of securities. That is point 2. Then protects investors' wealth. See, stock exchange is one place where licensed brokers, licensed agents will do the trading. So there is no chance that the investor's wealth is being, manipulated or used somewhere else, or he is kept in dark. There is no possibility. Okay, these days it is not possible to keep the investor in dark. Okay, and investment is not done properly or in an organized manner. It is not possible now because stock exchange looks into this matter and it protects the wealth of the interest and the wealth of investor through the enforcement of rules and regulations. Stock exchange is governed by, or it is regulated by SEBI, right? There is an agency called SEBI which is governing or which is regulating all the functions of stock exchange. So stock exchange cannot, enter into any illegal contracts. It will not let its brokers or agents to enter into illegal contracts. They have to have valid contracts only. So as such, whoever is investing amount in any companies, their wealth is protected because it is done in a very proper manner and in a very transparent manner. And no investor is kept in dark. I told you, every transparency is there. How my amount is invested, where my amount is invested, every transparency regarding prices, regarding the investment, every detail is there. Next, clearinghouse. Next is clearinghouse. Again, it is very important. I'll tell you how. What does clearinghouse means? You see, I should simply say clearinghouse means acting as the agent between two parties. Clearinghouse means acting as the agent between two parties. Let us say there is Mr. X. We have Mr. X. He is having shares of some company. Let us say he's having shares or debentures of Wipro company. He want to sell those shares, right? Now there is Mr. Y. He want to purchase those shares. X want to sell these shares and Y want to purchase these shares. But X does not know who Y is and Y does not know who X is. Obviously, not possible, no? Two different persons sitting somewhere, anywhere in the world, I can say, or anywhere in any part of India. So X doesn't know who Y is and Y doesn't know who X is. So here, stock exchange acts as a clearinghouse. I should say, what does stock exchange do is, stock exchange will take shares of Wipro from X and give it to Y and takes money from Y and give it to X. Simply speaking, to make it very easy, I'm telling what does stock exchange do? It acts as a bridge. It acts as an intermediary between two different persons who want to trade but does not know each other. So that facility will be done, that provided by stock exchange. Clearing house. Okay, that's it. Then provides liquidity. Provides liquidity. Just now I told you Just now I told you liquidity means converting into cash. So stock exchange provides a platform. Suppose I am holding 100 shares of a company. I am holding 100 shares of some company X Limited. I want to sell them. Where can I go? I'll go to a stock exchange and sell. So stock exchange provides liquidity to the securities. If a person wants to convert his securities into cash, he can go to stock exchange and do so. Next, help raise new capital. Suppose already existing companies are there. Already existing companies are there. They want to increase their capital. So they can issue new shares or they can also issue right shares. Okay. There is something called as right shares. Right shares are the shares issued by a company to the existing shareholders. Okay. If the company wants to increase the capital, it is in need of fund, they will issue right shares. But right shares are the ones which are issued only to the existing shareholders. If they are not interested, it will issue to some other, right? So even that is done by a stock exchange. Next, acts as a barometer. Now, like I'll give an example. What is thermometer? Thermometer is the gadget that measures the temperature of the body. Similarly, barometer is a gadget that measures the atmospheric pressure, whether it is high or low. In the same manner, if you want to measure where our economy is going, whether our economy is doing good or bad, if you want to know, stock exchange provides that. How? There are two indicators. One is called as Sensex. You might have heard somewhere. Sensex. And there is something called as Nifty. These two are the indicators of stock exchange. If Sensex and Nifty are going up, we say that the stocks are doing good, the economy is doing good, right? If the Sensex or Nifty is coming down, we say that our markets are crashing. That is, our economy is going downward. So a stock exchange acts as a barometer, means this. Next, increase credit worthiness of a company. Suppose there is a company, its securities are listed in stock exchange, in any of the stock exchange. Suppose Reliance company issues new shares and those shares are listed in stock exchange, that will provide more credit worthiness to the public, because to the company, I should say, because people will trust. People will trust the securities which are listed in stock exchange. They will easily invest in those companies which are listed in stock exchange. Suppose a company comes out with some bonds or debentures or shares and they don't list in the stock exchange, people will not trust such companies. People will trust only those companies which are listed in stock exchange. So by listing in stock exchange, the credit worthiness of the company increases and people are ready to invest in such companies. Okay, then minimizes the danger of speculation. I told you, no, stock market is very, very speculative. You cannot anticipate what would we see. Morning, 10 o'clock, let us say Monday morning, 10 o'clock, share market opened and I was having shares of some telco or like let us say Tata. टाटा स्टील का शेयर थे मेरे पास, उसका वैल्यू था 110 रुपया. कोई रीजन के वजह से, for certain reason, the shares came down to, let us say by 11 o'clock or by 12 o'clock, the shares came down to 80 rupees. Can it happen? Yes, it can happen. Suppose we came to know some big fraud, big scam that happened in some XYZ company limited. Because of that scam, the reputation of the company is at stake, the value of shares may come down. And even can happen vice versa. The value of shares can go up to 200 also, 300 also. That is why we say that stock market or share market is very speculative. We cannot judge, we cannot predict, right? But then if there is speculation, if there is a change in prices because of some illegal practices, that cannot happen. Stock exchange tries to eliminate, stock exchange tries to mitigate, stock exchange tries to minimize the dangers of speculation. It will not let the speculation happen because of some illegal practice. Because of some unlicensed brokers coming and doing the trading sort. I'm just trying to make it simple that illegal practices are curbed, illegal practices are not allowed in stock exchange, which will enable speculation. So when illegal practices are not allowed, obviously whatever speculation happens will happen genuinely. फ्रॉड नहीं होता, जो भी होता ट्रांसपेरेंटली होता, फेयर बेसिस पे होता. दैट इज व्हाट आई मीन टू से. तो स्पेकुलेशंस तो रहेंगे. यू कैन नॉट completely wipe out or eliminate the speculation. If speculation is not there, then what is the use of buying and selling shares? Nobody would come and invest in shares if speculation is not there. Speculation is always there with stock market, but speculation because of illegal market is curbed. It's stopped by stock exchange. So that is, what is it? Minimizes the dangers of speculation, right? Wrong speculation nahi hona hai. सही fair basis पे speculation हुआ, so that is allowed. Okay. And the last point we have, is it facilitates speculation. As I told you, if there is no speculation, then nobody would turn up to stock market. People will invest in stocks. People will invest in shares, anticipating that or expecting that they can make good returns. And the returns will be there only when there is speculation, when there is up and down. है ना? तो स्पेकुलेशन होना जरूरी है, बट एज आई सेड स्पेकुलेशन कैसे होना चाहिए? बाय फेयर मींस, बाय ट्रांसपेरेंसी, बाय फेयर मींस, राइट? So lastly, a stock exchange facilitates speculation also. Okay. The next question is, what are the principles of insurance? This question can also be asked as a SAQ, either as a LAQ or SAQ. Now, before we actually go to what are the principles of insurance, let us get to know what is insurance. Insurance is a contract between two parties. One, the insured. The second one, the insurer. One, the insured, and the second one, the insurer. Where the insurer guarantees making good the loss of insured, isn't it? That contract is called as insurance. So insurance, in insurance, we have two parties. We have one, the person, let us say A, and then we have the company, let us say LIC. A is called as insured. A is called as insured. And LIC or Max or any insurance, MetLife, any insurance company, that is called as insurer. So there is a contract between these two, right? That contract is called as insurance contract. And what is the contract? It is, the contract says the insurer agrees to make good the loss of insured. In the event of any loss, if it is a general insurance, in the event of any loss, the insurer agrees to make good the loss of the insured. In the event of any loss, insurer will pay the insurance claim to insured, provided he pays premium to the insurance company, right? Well, now let us see what are the principles of insurance contract. What are the terms and conditions of insurance contract? That we will see. The first one is very important. Utmost good faith. What is the first one? Utmost good faith. The insurance contract should be having utmost and a maximum level of optimum level of good faith. As I said, there are two parties, no? One is A and the other one is the company LIC. When, let us say, if I talk about life insurance, if I'm talking about life assurance, then A, while taking the policy, should declare or disclose all the, suppose he is having any disease, he should disclose all such facts to the insurance company. Suppose I am taking an insurance policy, and if I do smoke, let us say I smoke. So In the form, I should mention, if I am a smoker, I should say yes. But I am trying to hide that. And I said, I am not a smoker if I mention that in the form. And as we all know, those who smoke are prone to lung cancer. And because of lung cancer, I died. Then, if the insurance company comes to know about that at the time of settlement, they will disqualify the claim. They will reject the claim because the fact was hidden, isn't it? The fact that I smoke was hidden. So the claim can be rejected. So whenever we are entering into an insurance contract, it is said that on part of both the parties, not only A, even the insurance company should disclose all the terms and conditions very clearly before taking the signature on their forms. But somehow we do not go through all those terms and conditions. Later on, there will be a rift between insurance company and us. So it is always advised that whenever we are taking an insurance contract, we have to go through all the terms and conditions very thoroughly. And it is expected that both the parties will disclose all the material facts about the contract. Okay, hope you understood it. Second, insurable interest. Whoever is taking this insurance contract and on whatever asset or on whomever person we are taking the contract, we should have insurable interest in that asset. I'll give one example. Let us say, let us say Mr. A is there. He is having a car. He is having a car. The car value is, let us say, 8 lakhs. He wants to take an insurance on this for 2 lakhs or 3 lakhs. Will he be allowed to do so? Yes, he is allowed to do so. Because it is his property, he will be allowed to take insurance on the car owned by him. Right? But suppose A is having a neighbor. A is having Mr. B as the neighbor. And Mr. B also owns a car. B also owns a car. And A wants to take insurance on B's car. Is it allowed? Answer is no. He is not allowed. Sir, why is it not allowed when A is ready to pay the premium? Tell me, if suppose A's car meets with an accident, is it going to affect him? Yes, it is going to affect him. He is directly related because he has to pay the repair charges out of his pocket. But if B's car is meeting with an accident, how is A related in any? None of the way A is related to the damage, no? Will he be affected? Answer is no. So, if I want to take insurance on any asset or the life of a person, the asset or the person should be related to me and I should be directly affected by its existence or non-existence. If B's car is meeting with an accident, what is the damage I am going to pay? No. So why should I take contract on that? Not allowed. If I am allowed to do so, then it means that I am gambling. There used to be we used to have one policy by name wager policy, which is no more in existence. We cannot gamble on somebody else's asset or on somebody else's life. Suppose today I want to say I want to take insurance on my life. Will I be allowed? Yes, I am allowed. I want to take insurance on my wife's name. Will I be allowed? Yes, I am allowed. I want to take insurance on my children's name. Will I be allowed? Yes, I am allowed. If I want to take insurance on some XYZ, I want to take insurance on Amitabh Bachchan's name. Will I be allowed? I will not be allowed because I am no way affected by the existence of the Mr. B or no. Am I right? So if I want to take an insurance policy, I have to have insurable interest in that. Insurable interest means its existence or non-existent, should directly affect me. Then only I can take insurance on that life or the asset. Okay. Next is indemnity. Very, very important. Indemnity. Indemnity means we cannot make profit from insurance company. We cannot make profit from insurance company. That is, I'll give example. Insurance contract is for making good the loss of the insured, not to make profits. Suppose, again, there was this Mr. Rao. He had a car. Okay, he took insurance of the car. The car value was 8 lakh. He took an insurance of 5 lakhs. He took a policy of how much? 5 lakhs. He was paying premium on that. He was paying premium for 5 lakhs. And his car met with an accident. And he incurred a loss of 1 lakh. Listen to carefully what I said. I said he has taken a policy of 5 lakhs. And he was paying premium on 5 lakhs policy. His car met with an accident and the total damage was assessed or estimated at 1 lakh. Tell me, how much amount will the insurance company give? Will it give 5 lakhs because the policy amount was 5 lakhs, or will it give 1 lakh? The answer is the insurance company will give only 1 lakh. Insurance company 5 lakh रुपए नहीं देंगी. Insurance company will give only 1 lakh. Sir, why? The policy was of 5 lakh. He was paying premium on 5 lakh. But why is he getting 1 lakh? Just imagine. He has taken a policy of 5 lakh. He incurred a loss of 1 lakh. And if the insurance company pays 5 lakh, then is he not making a profit of 4 lakhs? 5 lakh minus 1 lakh, 4 lakh. It is not allowed in case of insurance. In case of general insurance, I should say, indemnity means making good the loss, not the profit. Agar aisa hua, so everybody would start doing that only. I'll take a policy on my asset. I'll take a policy of 10 lakh. I myself will lit fire. 2 lakhs ka nuksan ho gaya. Policy amount 10 lakh ka aa gaya. So I'll be in a profit of 8 lakhs. So it is not allowed in case of general insurance. It is not allowed. Whereas in case of life insurance, we cannot assess the value of a life. So indemnity principle does not apply to life insurance. It applies only to here. The principle does not apply to life and other types of personal insurance, right? Because we cannot assess the life value of a life. Whatever policy amount is taken, that amount will be paid as claim to the family of insured in the event of death. But in general insurance, what is the exact loss? Only that amount will be paid. We don't see what is the policy amount and all that. That is indemnity. Okay. Then we have subrogation. Subrogation means suppose again A took a policy on total stock of his godown. Let us say he was having furniture in his godown. He was having all furniture in his godown. And one unfortunate day, fire occurred in his godown and the stock is destroyed. The stock was valued at 5 lakhs. Insurance company is paying 5 lakh rupees to Mr. Rao. Insurance company agreed to pay 5 lakhs to Mr. Rao. Now, when the payment is made, when the claim is accepted, whatever is left over, like when fire takes place, not necessary that the entire stock gets burnt. No, suppose it is a steel furniture, only maybe the wooden part will get burnt. The rest of the steel part will still be there. So what will insurance company do after accepting the claim? That leftover of the furniture, जो भी furniture का लोहा स्टील बचा हुआ है, वो पूरा कौन लेके चले जाता? Insurance company लेके चले जाती. Why? Because it is making the payment. No, it is accepting the claim and making the payment. So whatever is left over will be taken over by the insurance company. This is called as subrogation. This is called as subrogation. Again, subrogation is not allowed in case of life insurance. Suppose there is Mr. A. Let us talk about Mr. A. He has taken a life insurance policy. He took a life policy. Okay. And the claim was 20 lakhs. So just imagine, will it happen like this? If he dies, insurance company coming and saying, see, this is the check of 20 lakhs. Take this 20 lakhs and give the body to insurance company. Will they ask like that? No, it is not. Because subrogation principle does not apply in case of life insurance. It applies only in case of general insurance, right? General insurance means insurance on the assets. Next is contribution. Next is contribution. Suppose there is a businessman, okay, very smart businessman. What he did, he took double insurance policy or multiple insurance policy. He took multiple insurance policies. Okay, say X is there. He has taken insurance from LIC for 2 lakhs. He has taken insurance from Axis Bharti AXA, let us say for 1 lakh. He has taken insurance from some other insurance company, let us say MetLife, 2 lakhs, like this. So totally the policy amount is 5 lakhs from different companies. And let us say X has taken insurance on a car. The car is damaged. Car is damaged and total loss is, let us say, 3 lakhs. The total loss is 3 lakhs. Or let us say, okay, let us say 3 lakhs. Now tell me, he has taken insurance from LIC, AXA, MetLife. So will he get 5 lakhs rupees? Will LIC pay 2 lakhs, AXA pay 1 lakh, MetLife pay 2 lakhs? No, it will not happen like that. What will they do? They will contribute in this proportion and they will make a payment of 3 lakhs only. They will contribute the amount and see to it that 3 lakhs only reaches to Mr. A, because that is the actual loss, no? Again, if I say, if this is paying 2 lakhs, 1 lakh, 2 lakhs, he'll be getting 5 lakhs. So he's making a profit of 2 lakhs. So not allowed. Okay. So in case of multiple insurance or in case of double insurance, what will happen? The insurance companies will divide the loss in proportion of the policy amount. Like we can say LIC was having a policy of 2 lakhs, AXA 1 lakh, again 2 lakhs, MetLife. So they will share the amount in 2:1:2. That is, the total 3 lakhs is there, no? 3 lakhs into 2 by 5. 5 6 the. So insurance company will pay 1,20,000, right? Then AXA will pay 60,000. Again, MetLife will pay 1,20,000. This is how you'll get 3 lakhs. Try to understand this. Very important. When multiple policies are taken, he cannot make good loss. He can make only good of the loss. He cannot make profit. Okay. So this is how the insurance company will contribute and he will get 3 lakhs rupees only, not the 5 lakh rupees. Okay. Next is mitigation of loss. Again, very important. Mitigate means to reduce, to decrease. Mitigation of loss. Now, what is mitigation of loss? Suppose we have this Mr. A. He owns a godown. Let us say he has a godown. He has an electronic godown. Okay, every time in that, there will be a stock of, let us say, 20 lakhs. He has not taken insurance policy. It is not advisable, let us say, but A did not take insurance policy. And on the day of Diwali, there was a rocket that barged into his godown and it is on fire. The godown is on fire. Tell me, what will A do? Will A simply stand and look at that? No, he will definitely put some effort to put off the fire. He will take every step to put off the fire. He'll call the fire station. He himself will take some, vessels and try to throw water on the fire. He tries to put off the fire. He'll make every effort. He'll request every person around to help him in putting off the fire. Am I right? Exactly. Now imagine. So what he was trying to do, he was trying to reduce his loss, no? He was trying to mitigate his loss. Now imagine this Mr. A has taken a policy and the same unfortunate incident occurred. Same thing happened and the godown is on fire. Now, if A is standing quietly looking at the fire, thinking that anyhow I have an insurance claim, I have an insurance policy, why should I bother? I will get the amount from insurance company, no? So if he keeps quiet like this, it is not acceptable. He should behave, though he is having an insurance policy, he should behave as if he is not having insurance policy and do all the efforts he would have done when he was not having a policy. In the case one, what he was doing, he was trying every effort to put off the fire, to decrease the loss. He should behave in the same manner, even though when there is an insurance policy that is said to be mitigation of loss. He should try to mitigate the loss, right? That's it. Next is the last one, causa proxima. Causa proxima. Now, what is causa proxima? I'll tell you. See, general insurance are of different types. general insurance of different types. Majorly, we have two. One is fire insurance, the other one is marine insurance. Okay. Now, let us say there is a go down. There is a go down. It has stock, whatever stock it is. And there is this person who owns the go down. And in the insurance policy, he has mentioned loss due to fire. Loss due to fire. There will be certain clauses, fire, water, theft, burglary, like this. There will be certain clauses. He included fire. He included water, right? He included these two things. And one day fire occurred in his godown. One day fire occurred in his godown. So all the stock was taken out and was kept in a safe place. And was kept in a safe place, right? Outside the godown, very far away from the fire. The stock was saved. It was salvaged. But then what happened? That night, some thieves, some thief, they came and they stole away the entire stock. Let us say 20 lakhs का पूरा stock चोर लोग आके लेके चले गए. Right? Now, tell me, will he get the insurance claim from insurance company? The answer is no. Why? Because in his insurance policy, what were the clauses mentioned? It was fire, it was water. Now, while assessment, they will see what is the exact reason of loss. Did the stock lose? Did he lose the stock because of fire? No. Fire did occur, but the stock was saved and moved to a safe place. From there, he stole away the stock. So what is the exact reason for loss? It is the theft. It is not fire. And this theft clause was not included in the insurance policy or the contract. That is why he is not going to get any claim. So causa proxima means the exact reason for loss. Okay. So we have covered 3 LAQs today. We'll continue the class tomorrow. Okay. So please go through all what we have learned in the class. Take care. Goodbye. Oh, 2 मिनट जान दो.